day, everybody, and welcome to a new year of webinars from Eide Bailey. In many ways, let's all hope that 2021 will be far better than 2020 for sure. And I think it goes without saying that all of us are glad to be in 2021. It certainly was a long 2020. We all did the best we could and figured out how to work differently and still audit or prepare our financial statements somehow, some way, most of us in a remote setting. And hopefully that spirit of teamwork will continue indefinitely. So in that spirit, let's get started with this year's series of webinars. Today's topic, we're going to take an expanded look at GASB's financial reporting model exposure draft. Now, why did I say an expanded look? When I presented a slightly different version of this webinar back in the dark ages of last August, and that was really a long time ago, there was a strong possibility that many of us were on vacation. And there have been a few responses so far, and certainly a lot of discussion on the financial reporting model improvements exposure draft, not only with GASB staff, but also among the various stakeholder groups, some of which you may have heard from or even participated in. And armed with that new knowledge and the understanding of what a lot of folks are thinking about, I'm going to present, some of the stuff you may not have heard before today. We also have a little bit of tendency of COVID fog, as it's been termed. We forget things we did an hour ago, let alone yesterday or 5 months ago. So it's time for a revisit on this important exposure draft from the GASB. For those of us of a certain age, including myself, should the elements of this exposure draft be approved as proposed, implementing the changes could be the wrap up of some of our careers. For others, it could be just the beginning. And so this is really a bunch of important changes that are being proposed here. Today's webinar, I'm going to walk you through the elements of the exposure draft, including all the proposed changes, some of the illustrations from the exposure draft within the exposure draft document, and even some potential journal entries. I'll also talk to you about the transition and implementation provisions, which, to lay your fears to rest, no, this is not being implemented coming up within 6 months. We have a bunch of time left on this one, should it be approved as proposed. Finally, there is an alternative view. No, this was not unanimously approved by the board. The alternative view may be thought provoking for you, and you may say, well, wait a second, I kind of find that interesting. Or you may say, well, I'm not so sure about that. You may want to comment on the document, and for your decision makers, there's even user forums that have been set up by the GASB. If you happen to have some decision makers, say on your governing board, that may be very interested in how financial reporting will look like, say, 3, 4, 5 years from now. An unprecedented 10 potential opportunities are out there to voice your view, whether you're an auditor, preparer, or user of financial statements, coming up during March and April. Now, these were supposed to be live. But unfortunately, COVID got in the way in between, when the exposure draft was issued last June and now. There was wishful thinking on the part of the GASB staff and actually doing user forums around the country. Well, now those are all going to be virtual, so there's no excuses out there in not being able to potentially voice your view. Now, it's a bit tricky as there are two other due process documents that are also having hearings at the same time. So far, the GASB hasn't separated that stuff out as of yet. We're going to be talking about the revenue and expense recognition preliminary views document during our February, March, and April webinars. Finally, there's a GASB concept statement proposal which mirrors some elements in the financial reporting model improvements exposure draft. Now, you may not have ever heard of GASB concept statements before, and it's because they're not authoritative to preparers and auditors. There would be a bunch of duplication between what would be in this webinar and what would be in the concept statement. So I'm not going to talk to you about what's in the concept statement because I'd just be repeating myself. I can talk to you offline if on that one if you're really interested. But what concept statement are? They're the guidelines for the GASB board in saying here is the framework, or as we call it in GASB Geekland, the conceptual framework as to how financial reporting and accounting is established. And if you're interested in something like that, I'm more than happy to talk to you about it. When folks ask me about the conceptual framework, I sort of liken it to, say, a farm, and the fences around the farm are the GASB's conceptual framework. And so if you're into that sort of stuff, I'm more than happy to talk to you on it. But to the business at hand today, the GASB's exposure draft, financial reporting improvements. Okay, you asked for it, and now it's here. We're going to walk through the exposure draft, and on your screen there are six items that we're really going to focus on. And if we have some time at the end of the CPE session, I'll give you a quick update on the what the calendar looks like on a go-forward basis for GAAP, as well as hopefully have some time taking your questions. So indeed, it is here. The GASB released the exposure draft for the financial reporting model improvements project. Now, I've been working on this project since inception. I'm on the task force, and there is a very wide group of us that are on this task force. There's 30, I think 30 some odd members from all different types of professions, preparers and auditors, all having obviously something to do with governmental accounting and financial reporting. There's even educators on there and other stakeholders. And so there's been a wide ranging views, and indeed it's been a long and winding road. We started off with a hope for at least for the first year or two of the task force that the GASB would look at things with a clean sheet of paper. After all, the bulk of the current accounting and financial reporting model was nearly 2 decades old. The project that became the current model, which I also worked on and of course I was much younger, had a lot more hair. That project for what we're using today, and most of us know it as GASB 34, that project was started before Excel was even invented. That's how old it is. We were using Lotus 123. And we were using Word Perfect. Microsoft Word hadn't been invented as of yet. That's how old we're talking. Both programs were awesome for the day, but both were on these things called floppy disks that held about as much data as your average tweet these days. Now, those of us on the current task force, we said, okay, GASB, let's come into the internet age. That was our mantra. And let's go into the internet age. Let's start off with a clean sheet of paper and let's roll forward. Well, applying that mantra ran into some serious headwinds, especially from those of you who are preparers. Those headwinds are why this document is the third due process document on this project. To give you a sense of where we've been and on what we're talking about today, The initial preliminary views of the board, recognition of elements of financial statements and measurement approaches, that was issued in June of 2011. Yes, folks, nearly a decade ago, in the dark ages before Zoom. Zoom wasn't even an apple in anybody's eye back in 2011, and that's where this whole thing started. And again, I was on that task force as well. That document included revenue and expenditure recognition concepts for governmental funds and a re-examination of the financial reporting model. Now, given the major negative response to that project, the board suspended that project during 2012, ripped it up, took a step back, and started new research in 2013. To give you a sense of what the GASB went through, GASB staff randomly sampled 465 governments of all types and sizes, collecting information on how governments were preparing their annual financial reports. Some of you who were sampled may be on today, and you may not have known it. 11 roundtables were held during 2013 and 2014, identifying key issues in financial statements. The roundtables included auditors, preparers, and users, and I was involved in those roundtables and in the follow-up interviews that also occurred. Now, the board gave the go-ahead for a new project in 2015. Again, we're talking 6 years ago. The initial due process document and invitation to comment was issued by the GASB staff a year later, and it involves just the GASB staff's views on the existing financial reporting model and governmental funds, including measurement focus and basis of accounting, which we're going to be talking about today, whether the statement of revenues, expenditures, and changes in fund balance needs to be updated for governmental funds, a lot of terminology changes, the reconciliation between the governmental funds and the government-wide financial statements. And remember this one, governmental funds statement of cash flows. Should we do a statement of cash flows for those funds? And that caused a lot of people to get a little upset. Well, so much so, the GASB received 111 comment letters and heard testimony from 48 respondents at 5 hearings, and there were an additional 30 responses from 3 user forums. The board then went back to the drawing board and digested all that feedback and added even new topics that were not in the invitation to comment. During 2017 and into 2018, there were topics added on government-wide financial statements, proprietary funds, budgetary comparison information, and a lot of us remember that back in 2018, there was a preliminary views document that gathered all this information. That was released in September of 2018, and I can remember doing a webinar for all of you during a blizzard later on in 2018. Actually, it might have been in early 2019. This time, the board received even more feedback, 151 comment letters at that time, and they received testimony at more public hearings and user forums. Staff also started field tests in 67 different governments. They actually went out to the government and worked with them to help potentially implement the new financial reporting model. The board also added even more topics, especially on the MD&A, debt service fund information, special and extraordinary items. Now, this work was going on from 2018 and into 2019, and then finalized last June. And last June, we had the exposure draft release, but all of us were kind of focused on COVID-19. And that's why the board gave us a lengthy time period to respond to this exposure draft. Comments aren't even due until the end of February, and we'll talk about the comment process a little bit later in this session. But we only ended up with 5 magic words. The bottom line, it could have been worse. There are four areas proposed of, at least in the case of my opinion, somewhat major changes in three areas of other changes, which in many cases are proposed to be not so big of deals, depending on your government. They may be a big deal, they may not. To give you some of a sense of the exposure draft largesse, the summary, proposed standard section, background, basis for conclusions, alternative view, and again, yes, there is a dissenting view, and journal entries showing the proposed basis of accounting for governmental funds. All of that stuff takes up 68 pages. The scope of changes section, all the impacted GASB statements, all the proposed impacted technical bulletins, all the proposed impacted implementation guide questions, and so on. That's 4 pages in very, very tiny print. There's also included an illustrative management's discussion and analysis and financial statements under the proposed model. That's 41 pages, which, by the way, one of our senior managers helped write based on a real city. She's detailed as a GASB fellow working on the project, and who knows, she may be on today, listening in. And making sure I'm saying the right things. The codification instructions, 157 pages, many of which are implementation guide questions and answers that may change. And to me, the codification instructions, those are really important because I happen to live a lot in the codification. Those of you who also attend stuff or subscribe to GFOA has completely gone codification as well in the new blue book, and I think it's really easy to go through. But whenever you change the codification, it gets to be a real challenge, and there may be some stuff that they missed in the process. Are any governments proposed to be exempted from this 271 page proposed document? Only if your government strictly presents non-GAAP financials. All other governments that present GAAP financials would be required to implement this if and once it has been approved. So let's take a deep dive into the pool here. And the first section is on the management's discussion and analysis, or MD&A. Yes, the GASB knows that many auditors prepare the MD&A, but preparers should know that the users of the financial statements continue to believe that the MD&A is your most important section of your financials. I bet you didn't know that your users, whoever they may be rating agencies or bondholders or those charged with governance, they believe that your MD&A is the most important section of your financials. That's what came out in the roundtables. Yet it nearly always is the last thing to get done, except in a very few governments that actually rewrite the MD&A annually. That's only a small handful of governments that I know of that do that. Now, there are some folks that may be on the line that say, okay, once the annual financial report is done for the year, I give it a rest for a few weeks, and then we roll things forward and review the MD&A with a clear set of eyes. That's a good best practice to do so. And it's something to do. Let's say you're a June 30 government, you got the annual financial report out for 2020. And let's say you have a free hour or so, or in your day, which I know that you're all laughing at that. But let's say you had a free hour or so in your MD&A. It might be a good idea to roll it forward from last year and take a clear set of eyes, and I bet you'll realize that there's maybe a sentence or two that you say, now why did I write that? And you just published it perhaps maybe 3-4 weeks ago, depending on your year end. But that's a really good best practice to do so. The goal of the MD&A, even in the exposure draft, is a reemphasis of what is already in GASB 34. You're supposed to have an objective and easily readable analysis of your government's financial activities. And this is based on currently known facts, decisions, or conditions. And you're also supposed to present comparisons between the current year and the prior year with a focus on the current year in order to assist your users in understanding this basic question: why? Why did the balances and results change? But the GASB is proposing in the exposure draft to add a section requiring writing in a manner that can be understood by readers who might not have a detailed knowledge of governmental accounting and financial reporting. You say, wait a second, I have to sort of dumb down my language? Well, yes and no. You're not supposed to have a detail that the language used in there is supposed to be for somebody who doesn't have a detailed knowledge of governmental accounting and financial reporting. The MD&A also should include explanations and interpretations that will help your users understand the information that's provided. Well, we got a problem here on that one then. But that concept's been around since the beginning of the GASB. It's in the initial statement, the initial conceptual framework of the GASB, GASB Concepts 1, and that was issued in the 1980s to have an easily readable set of financial statements. And yet somehow we all miss that. The GASB also believes that it is a shared responsibility. Yes, the messages contained in financial reports are intended for users, but to effectively interpret those messages, the user is also responsible for obtaining a reasonable understanding of your government. And also, if you happen to issue things like debt or leases or whatever, also the public finance activities and the fundamentals of governmental financial reporting. In that way, they can study the messages with a certain amount of due diligence and for applying analytical skills. That's been around since the 1990s in GASB Concepts 3. Now, I mentioned this phrase reasonable understanding or reasonable diligence, although the GASB believes that reasonable understanding, this threshold of reasonableness, should be applied to the information in your basic financial statements. The board also believes that an objective of the MD&A is to communicate information to a broader range of users. Long and short, maybe at some point, if you did want to start with a clean sheet of paper for an MD&A, maybe have your nearest teacher read it. When I was implementing GASB 34 as a preparer almost 2 decades ago, that's exactly what I did. I'll give you a little secret. I actually asked my mom to read it, but she was a retired English teacher and librarian, and quite frankly, it opened my eyes. She also said I was a terrible writer back then, but that was almost 20 years ago. Another thing you may want to consider is to establish some form of investor-focused website. And that may give your users a reasonable understanding. Some of our clients already do this. Contained in the website could be all of your annual financial reports, budget documents, bond offering statements, rating agency presentations, compliance documents, and maybe even a glossary or even a primer on what your government does. But it's all focused to your investors who would meet this definition of a reader who may not have a detailed knowledge of governmental accounting and financial reporting. Of course, Eide Bailey can help you with this if you ever did want to establish something like that. Now, the five major sections of the MD&A are still the same as of today in the exposure draft, but the information in those sections is proposed to be limited to these topics. And you're supposed to follow this sort of format. So I'm going to read you the topics, and then we'll explore each of the topics in a little bit more detail. First, there's going to be the introduction, just like today, but make it brief. Second, a financial summary. Again, make it brief. The information is supposed to be condensed. not a copy. The GASB makes a point of saying that. The third piece is are our detailed analyses, but there'll be a change here, and just wait for it. It is coming up. The fourth piece will be significant, and I underscore the word significant, capital asset and long-term debt activity. And then finally, our favorite section, currently known facts, decisions, and conditions. The GASB is also emphasizing that the analysis provided in the MD&A should avoid any unnecessary duplication, repeating explanations that may be relevant to other sections, and that boilerplate discussion should be avoided and only include the most relevant information, and of course focusing on your primary government. Now, let's talk a little bit about significant capital asset and long term debt activity. Now, notice I emphasized the word significant when I mentioned it. Given the GASB standards that we've talked about over the past few years in various webinars, or when I've done things in front of you live, we talked about leases, public-private partnerships, subscription-based information technology arrangements, conduit debt obligations, just to name a few. All of those could be included in the section that says significant capital asset and long-term debt activity if they are significant. Now, the word significant, it has no GAAP definition, but it generally means worthy of attention. Is that more than material? Perhaps. It depends on your situation. Remember, information described to be material usually means that if you leave it out, if you omit it, or you misstate it, it could influence decisions that users make on your government's financial statements. So if you leave it out, that's probably a material omission. Now, I've done some research on this, and again, there is no definition in GAAP for the various thresholds determining what is material or what is significant. But we need to think about it. Whenever we prepare financial statements, we consider quantitative measures and qualitative measures when we think about materiality. Now, putting things in perspective, over including what we learned over the past few years, we have about 5 different thresholds of determining what is for example, a liability. At the top of the scale usually is this thing called reasonably certain, and we use that, especially in the leases standard, for those of us in the process of implementing GASB 87. Some of the decisions we make are based on a reasonable certainty. And perhaps the next level down is probable. And we use probable when thinking about a claim or a judgment. Now, some of us say the word probable means 75 to 80%, while others say it's much lower, of something certainly going to happen. Now, again, there's no mathematical threshold on that. And then there's this threshold called more likely than not. Now, a few years ago, this phrase was added to the determination of whether or not a government may be liable for payments related to a non-exchange financial guarantee. That was GASB statement number 70. God, that seems a lifetime ago. Now, some of us say more likely than not means 50% plus a feather. And we say it sort of jokingly, but some of us say 50% plus a tiny, tiny bit more. The next level down likely is material. And the word material is in nearly every GASB pronouncement, but it's undefined by the GASB. Now, there, of course, you auditors out there, you deal in materiality every day. And you know that there's a quantitative materiality and a qualitative materiality, and it's defined in various ways. But that's auditing standards. So if material is less than more likely than not, then significant is less than material. And if you think about it, some of our significant items we disclose, and we disclose those as our first note in our basic financial statements. Now, we don't disclose all of our accounting policies. We disclose our significant accounting policies, usually as note one. Now, is what I just described a hierarchy of recognition? No, it's very speculative based on what is already in GAAP. It's my opinion. But one can imagine the word significant may be more or less material in a quantitative or qualitative sense, and that's what would go in your capital asset and long-term debt activity. So let's get back to the rest of the MD&A. Of course, the GASB also knows that many of us, we copy the illustrative MD&A from GASB 34 and the implementation guide. We've all done it. I did it as a preparer, and we adjust things annually. That's probably going to continue, I bet, as the illustrated MD&A in the exposure draft is very easy to read. But notice also GASB is continuing the inclusion of currently known facts, decisions, and conditions. I'll get into this more a little bit, so hang tight on that one. And GASB is also going to continue the requirement that information included in the MD&A distinguishes between the primary government and the discretely presented component units. So long and short, the MD&A doesn't have a whole bunch of wholesale changes, but there are some significant changes in there. This is the first illustration in the MD&A. Notice how it's different than the one you may have previously copied from the GASB implementation guide for GASB 34 way back when, back in 1999 or 2000. Even the GASB wants to eliminate boilerplate. My guess is if the exposure draft approved as is, I bet this will be copied for decades to come because it's really easy to follow. Now, notice on the right-hand side, the spectrum of details about activities from less to more. The basic financial statements are, of course, they're the summary of all your activities and results of operations and your balances. And that's at the top of the scale there, your basic financial statements, your government wide and so on. And then you have your government activities, your business type activities, discretely presented component units, and off to the right hand side, your fiduciary activities. And the next level down is your funds, and the next level down is your notes and your required supplementary information. That's pretty much the way it is today. And again, the basic financial statements are summaries, and the note disclosure and RSI are detailed as they should be. Another illustration in the MD&A summarizes the different types of basic financial statements, the funds and the elements within the financial statements. This again could result in boilerplate, but I also think this is among the clearest discussions yet on what is in the basic financial statements and how they all work together. It's really easy to follow, and I'm glad GASB staff put this together because a lot of us don't understand what is in a deferral and what is an inflow and outflow, and what is an asset or liability. Certainly not the casual reader of your financial statements. And so this makes it pretty easy to follow. And again, right out of the MD&A in the exposure draft. This first table in the MD&A remains the highly summarized statement of net position. Again, not too tough to take. And in fact, guess what, folks? No change from current GAAP. There is an emphasis within the exposure draft to summarize the items in this table. Now, you've done it, I've done it. All too often, governments just copy their entire statement of net position in the basic financial statements in the MD&A. Well, that makes things easier to review. It's not what is required currently, and it is not what is supposed to be in your financial statements, and it's not what is proposed in the exposure draft. You're only supposed to do a summarization. So just to take a look at what's here, you got capital assets, current and other assets, long-term liabilities and other liabilities, the deferred outflows and deferred inflows of resources, and the various items in the statement of net position. That's it. Now, for comparative financial statements, once implemented, and I'm emphasizing the phrase once implemented, assuming that this goes forward as proposed, the 3-year presentation would likely be included, again, only for truly comparative financial statements. But we'll get to that when we talk about implementation a little bit later on in this CPE. So for now, if you don't do truly comparative financial statements, stick to the 2-year presentation. The statement of activities, again, no change from current GAAP, not too tough to take. You got program and general revenues and expenses by function. And we'll get to an item at the bottom of the page real soon, something that says, and I know it's in small print, especially if you're watching this on a iPad or similar or some other mobile device. That printing's pretty small. But we'll get to an item at the bottom of the page pretty soon, something that says unusual and infrequent items. I'll show you what it looks like a little bit later. And again, I can barely read it on a 24-inch screen in front of me, and I bet it's a little harder for you on a laptop or smaller. The analysis areas in the example MD&A and the exposure draft are almost the same as many current MD&As. Almost is the operative word. But if you take a look at the example MD&A, you get a sense that it is less hefty than perhaps your current version. I know the underlying city used for the MD&A, and it's a large government in the middle of the country. You know, a 28-page paragraph, not 28-page, 28-paragraph MD&A is likely shorter than many comparable governments. If this does get approved, could you see a space savings in your MD&A? Maybe, but other areas may increase, as we'll talk about real soon. But start to think about that, especially over the next couple years, and see if you're really doing things. You're a little long-winded in your MD&A. Might not be a bad idea to take a fresh set of eyes and take a look at it in advance of these changes coming up. So, a few slides back, I promised you that I would talk about currently known facts, decisions, conditions that are expected to have significant differences from the current period. That word again, significant. Notice the wording there. The current period refers to the reporting period, the one that is just passed. This is forward-looking, but using currently known information that is significant. Examples of types of information that could be included in this area include a lot of things. For example, trends in relevant economic and demographic data, such as changes in population. Let's say, you had a annexation that went on, or you spun off a new subdivision into a separate government. Maybe you want to do a change in population for specific age groups, customer base, income levels, building permits, enrollment or unemployment rates. I mean, certainly this year for things like airports and transit systems, changes in customer base, that's a currently known fact for sure. Information about the next year's budget, such as changes from the current year and the total amount available for appropriation, say, such as taxes, fees, changes in tax rates or fee amounts, changes in economic basis or ranges of activities. Say you approved a new tax base or something like that. Changes from the current year in planned spending, such as inflation. Let's say you got a new collective bargaining agreement, new laws, regulation, and so on, or expected changes in net position or fund balance. Could be even from implementing a new GASB standard, and you know that your net position or fund balance may be restated coming up in the next year, and it's a currently known fact. Another piece that could be in there would be information about the actions that your government may have taken at year end, after the reporting period. And maybe you made a change on pension contributions or OPEB contributions or capital improvement plan or long-term debt, lease agreements, PPPs or CBITAs. All these things could be a currently known fact that was done after your reporting period, but prior to the auditor's report being issued. So could they go in there? Sure. Now, this is not all inclusive, as the factors may differ. Now, some governments, I mentioned collective bargaining agreements. Some governments don't have collective bargaining agreements. Some governments are not part of statewide cost sharing pension plans. Now, if this provision gets approved, will the GASB issue implementation guidance on this aspect? Let's just say more likely than not. I'm sure they will. Using the questions already in the implementation guides as a proxy, right now, before this exposure draft, we already have two questions on what is the definition of what is a currently known fact, and when do you make that determination? My guess is that will be expanded. Now, under current GAAP, the measurement of currently known facts occurs as of the date of the auditor's report. And many of us miss that because it was a footnote to GASB 34. Now, that footnote was not contained in the exposure draft, and it's unclear if that'll change. But right now, we look all the way out to the date of the auditor's report. But I circled that one in my exposure draft, and I bet that's something I'm going to ask a question on. Now, the phrase currently known is emphasized. The items within the section would be what has occurred prior to the issuance of the financial statement and not speculative. Remember, you're not a weather person. You're not predicting the weather for tomorrow. We're not supposed to be speculative. Don't guess any predictions or, frankly, political items. That's best in the introductory letter and not in the MD&A, just like today. So, what's not in the MD&A? I mentioned a few minutes ago that there'll be a major change in the detailed analysis piece of the MD&A. So here goes. Well, the GASB is proposing that the analysis that seems to be the bulk of most MD&As that I've prepared and that I look at is no longer going to be presented in the MD&A. And I know I'm moving your cheese. That's the budgetary analysis. Don't totally exit out today because, hey, this is just a proposal. And don't get upset at it. Don't delete it because all we're going to do is we're going to move it. The proposal is not to include the budgetary analysis in the MD&A. And that's going to be a big change for a lot of governments, assuming this is approved. Now, a smaller change proposed similarly is the discussion of the capital assets section would also not include a discussion on the modified approach for those governments who do modified approach. For example, state of California does that. That's not going to be eliminated. It's just moving again. And so take it out of the capital asset section. Don't eliminate the entire capital asset section. It's just going to move to the RSI. So be that as it may, the GASB is doing research on whether or not capital asset accounting and financial reporting should be modernized, and should there be things like deferred maintenance in there? Could there be changes to the modified approach with that? Who knows? But we're talking years and years from now. They're just starting research on that. Under current GAAP, governments are limited to those elements required for MD&A as it's regarded as RSI. Now, can governments go beyond those areas? No, not under current GAAP. Governments are currently allowed to provide additional analytical or descriptive data within those categories going beyond those minimums, but the categories themselves are the categories that are required. Information not currently in GASB 34 doesn't belong in the MD&A, but it could be in supplementary information or in an introductory letter. Will the GASB change this? Well, that's an open question. I spent a lot of time in the MD&A because a lot of us think that that's really where a lot of the action is, but there's some other stuff we're going to go to. So now that we've explored the MD&A elements and spending a ton of time in this, the next piece is on unusual or infrequent items. There's a bunch of information released about the GASB's, technical bulletin on COVID-19, and one of the questions was on whether COVID costs were extraordinary or special items. They're not, by the way. They're not extraordinary or special items. COVID-19 costs, even as a result of things like stay-at-home orders or so on, those are not extraordinary or special items, and that's within the technical bulletin that was also released last summer. In the financial reporting model exposure draft, the GASB is proposing to combine these items just like the FASB does, but not change the underlying language. The presentation on the face of the financial statements would be combined, and then note disclosure would result of an aggregated amount. And if you want to see what it looks like on a combined, it's at the bottom of the screen. It says unusual or infrequent items, flood damage cleanup for, in this case, $7.5 million, because these numbers are in thousands. So the language is not supposed to change, just the presentation of the unusual or infrequent items. It's right there. Now, what would a note disclosure look like? Here's a sample draft note disclosure on this. Again, easy to take, not too much verbiage on it. Just explains the $7.5 million and which functions of the city that is that was impacted by the flood. Not too tough to take. Only a couple of sentences. With that, you're probably going to say, okay, Eric, where do I get further information on the things that used to be extraordinary items or special items? Well, the GASB is proposing to utilize existing GAAP that was issued right after GASB 34. GAAP requires information that is highly summarized in the basic financial statements to be disaggregated and put in the notes. And again, here's what the example would be. Could you have a separate paragraph if your government has both what is currently an extraordinary item and maybe another activity that was a special item? Well, sure, but I would probably just have a separate subheading. But again, we're getting ahead of ourselves. Here's what it looks like in the exposure draft, not too hard to deal with. And that leads us to question number 2, Amy. Yeah, I think you're right. Yeah, just outflows, and that was in the technical bulletin. For those of you considering doing extraordinary items or special items, take a look at the technical bulletin. It's freely available. It's question 6. Just have those as outflows. Certainly, if you have a grant, to help deal with the costs of COVID and so on, say from the CARES Act, that would be just an inflow. But or perhaps if you have costs or assets that were received prior to eligibility, that could be a liability. Remember, so in any event, just outflows in this aspect. So let's keep going here. All right. So the next piece is probably the one that's going to cost you the most angst. But when governments scrape away the angst, they may realize, hey, wait a second, this isn't so bad. The financial statements for governmental funds are proposed to change. And we'll get to that in a few minutes. But for now, let's talk about building those financial statements of governmental funds. The most important aspect in the presentation of governmental funds being proposed is that there's going to be a conversion to what's called the short-term measurement I messed it up. The short-term financial resources measurement focus and accrual basis of accounting. If I can mess it up, you're probably going to mess it up too. So let's say it again. The short-term financial resources measurement focus and accrual basis of accounting. You're saying, wait a second, what's Eric saying there? Sounds like a bunch of gobbledygook. You mean my governmental funds may change from the modified accrual basis of accounting that's been there since the dinosaurs walked the earth? Uh, could be. So let's break it down a bit. Okay, the financial statements for governmental funds are being proposed to apply the short term financial resources measurement focus in accrual basis of accounting. And as we learned in Counting 101, measurement focus refers to what items should be reported as in your financial statements, and basis of accounting refers to when those items should be reported in your financial statements. Now, the short term financial, and I emphasize the word financial resources measurement focus incorporates outflows of short term financial resources and inflows of short term financial resources and all short term financial assets. It also includes deferred outflows of resources, liabilities, and deferred inflows of resources, even has fund balance. Now, then you're saying to yourself, okay, what's the big deal? I mentioned the word financial, emphasizing it several times. We're going to be focusing on cash and investment driven transactions, but we also need to align to the accrual basis of accounting. The GASB is proposing under an accrual basis of accounting that elements of financial statements arising from short-term transactions and other events are recognized as they occur. Elements of financial statements arising from long-term transactions and other events are recognized when payments are due. Now, that's a big difference. For the purposes of recognition in financial statements, in applying this thing called the short term financial resources measurement focus and accrual basis of accounting, events that are recognized in the financial statements would include transactions or external events between a government and some other party or parties, say contractors or taxpayers or you name it, that have financial consequences for the government, meaning cash in and cash out. And it may include other events such as internal events, such as a lot of us do cost allocations, such as allocation of inflows of resources to individual funds. May even include external events such as changes in fair value. But remember, financial assets in this measurement focus includes cash, assets that are available to be converted to cash, and assets that are consumable in lieu of cash. Any sort of liabilities in this measurement focus would be financial liabilities. We'll get to the short term versus long term jazz in a little bit. But because of this changes in the measurement focus and basis of accounting, the GASB is also proposing to move another piece of your cheese. They're also proposing to change the terminology from special revenue funds to special resources funds. Now, why are they doing that? Well, it's because the GASB wanted to recognize not only the inflows, which is normally what we call special revenue funds. After all, the word revenue is in there. We don't put the word expenditure in there. They wanted to recognize not only the inflow side, but the outflow side from those funds. Folks, it's just a title change. So this one we can say, okay, I can deal with that. Not too tough to take. But let's dig a little deeper. What goes into the governmental fund financial statements will be balances of short-term financial resources and flows relating to long-term financial resources. But we're going to separate those short-term from long-term, which is again a lot of jargon, so we almost need to break it down a lot further. Whether a transaction or other event is short term or long term is determined by the period that elapses between the inception of the transaction or other event and the conclusion of the transaction or other event. And then you measure the time frame. Short term transactions and other events are those for which the period of inception of that transaction to the conclusion is 1 year or less. So that whole 60-day stuff is going to go away for GAAP external financial reporting purposes. Budget is totally separate. We're not talking budget here. We're not going down that road. We're talking about for GAAP external financial reports. Long-term transactions and other events are those for which the period from inception of that transaction to the conclusion of that transaction is greater than 1 year. Now, for most of your transactions, not a big deal. After all, somebody walks up to a counter and gets a permit or a license, it already is cash in and cash out. As auditors, we know that. Not a big deal, short term, or let's say your pay for a pay cycle. Short term, not a big deal. Long term, not much different than today. After all, if your government has a debt payment due on July 1st and you happen to be a June 30 reporting period end, the debt payment is not reported as a liability. But that's where a lot of controversy is. A lot of folks think that that liability should be reported in your governmental funds. After all, it's due at 12:01 a.m. the following day. If it was due at 11:59 p.m. of the current day, but unpaid as of 12:01 a.m., then the debt payment would be a governmental fund liability even under this exposure draft because it's due. It's not due on July 1st, it's due on June 30 if you happen to be a June 30 period end. Now, the measurement from inception to conclusion is controversial already, as some transactions may last much longer than 1 year. There's one comment letter already posted to the GASB's website that says, we strongly disagree with defining short term within 1 year from the inception of the transaction or other event. We recommend maintaining the definition of short term to be 1 year from the date of the balance sheet, which is a very different date. If payments are made or received prior to the due date, the elements from long-term and other events such as debt service and so on, they're recognized when payments are made or received. So what's missing, Eric? The concept of normally. Now, that concept of normally, that's been in place since an old GASB interpretation was issued around the same time as GASB 34, but it was not uniformly adopted. So why is GASB doing away with this stuff? This concept of normally? Well, you can thank certain governments around the country for causing this change by not paying their bills on a timely basis. There are governments out there that takes years for them to pay their bills. And as such, the normal course of business for them is to pay their bills in years, and therefore their accrual period is years long. But many of you don't operate like that. Many of you may have a 60-day accrual period, and that's just fine. So there might not be a lot of change for you in this conversion to governmental funds, with the exception of how do you measure transactions. What does this all mean? So let's take a look first at the assets and liabilities. Again, not too much change in this definition other than short term or in long term. And once you classify that short term and long term, it retains. And there would be no changes to your deferred outflows or deferred inflows. Just GASB gets to choose what is a deferred outflow and what is a deferred inflow. And again, this measurement period seems to be the only major real change that's there. But you may also notice there's a little bit of a change here. I yellowed it. It says the word binding arrangement, and we'll get to that in a little bit. But by and large, cash, investments, accounts payable, accounts receivable, not too much of a difference between what we currently do today. Now, again, this term binding arrangement, there's a reason why I'm going to emphasize. We're going to spend a couple of minutes talking about this term binding arrangement because you're going to hear this phrase over and over and over again. The auditors on the webinar, they've been living this stuff for a while. If they do not-for-profit audits or for-profit audits, those auditors had to understand this thing called FASB Topic 606, which was pure joy. And I'm sure you're laughing right now. By the way, many of those aspects of Topic 606 are going to creep their way into GASB's revenue and expense recognition project. And we'll talk about those over February, March, and April. But for by and large, right now, not too many changes in what we're looking at in terms of funds, except for this recognition period. So let's dive a little deeper in what is this binding arrangement. And again, you're going to see this over and over and over again coming in the future. A binding arrangement is an understanding between two or more parties that creates rights, obligations, or even both among the parties to a transaction. It can be written, oral, or implied by a government's practices and procedures. And examples of a binding arrangement include legislation, it includes referendums, it includes contracts, it includes grant agreements. Now, the binding arrangement may produce one or more transactions and for the purpose of determining whether a particular transaction is long term or short term. And that's why we're spending a few minutes here. When none of the parties have completed any of their required actions, well, then a transaction hasn't occurred yet. A transaction first occurs when one party completes an action they're supposed to do. Now, there's a piece in a binding arrangement called a rebuttable presumption of enforceability. I'll get into this in a few seconds, but for now, let's just say the parties to the contract think that the contract is a legal document. And by entering into the contract, you think it's legal and it is enforceable, but we all know that any court of law can probably rebut something like that. Again, there could be more than one transaction from a binding arrangement. The contract determines if there's more than one transaction. However, if there's no required actions by the parties to the arrangement, in which case no one needs to do anything, well, guess what? No transaction, no binding arrangement. At least one party must have to have some form of required action to generate some form of transaction. That could be as easy as passing a law. If you pass a law, transaction may occur if the law pertains to things like raising taxes or lowering taxes. Just like what happened in the governmental fund proposal, the inception of a binding arrangement is when the event starts, when the parties agree, when the law passed, when the grant agreement is signed. It concludes when the agreement ends. The measurement of the term is the period from the beginning to the end. Just like leases, once classification occurs as short-term or long-term, the classification stays the same, and even if conditions change. If there's a modification of the terms and a cancellation occurs, say at the end of the old lease, well, then the old binding arrangement goes away and the clock starts ticking again. So let's say renegotiate debt or refund debt or modify a lease or terminate a lease. No more binding arrangement, brand new binding arrangement. Now, when we went through accounting classes, one of the things that we may have learned is basic contract law. We've already gone through the provisions of contracts, including multiple parties and so on, but there are a few more steps. The parties must comply but not agree to must comply to the terms and conditions. But we know in government there are three co-equal branches. There is the executive branch, there's the legislative branch, and the judicial branch. We all learned about this in grade school. There's also multiple levels of government, and whatever is not in the jurisdiction of the federal government is delegated to the states under the 10th Amendment to the Constitution. given that the judicial branch can adjudicate disputes over contracts and even laws, regulations, federal laws, that can adjust compliance. Binding arrangements are not absolute. That means they're rebuttable. Given these relationships, there must be mutual assent. The legislative branch passes the law. The executive branch can veto the law, but the veto may be overturned by the legislative branch or the courts. And ultimately, there's an agreement on terms and conditions. Even if there are one-way contracts such as referendums to raise taxes. Now, I'm talking to you a lot about civics, but it really goes to how we do our accounting and financial reporting. The next step is there must be some form of economic substance to the contract. One party has economic consequences and the other one has benefits. Think about it. If you're earning wages today, you earn an economic benefit, but there may also be an economic cost because you might have to have income tax withholding. One party has benefits, another one has economic consequences. If you buy a gallon of gas, included in the price are various taxes. By buying the gallon, you agree to be taxed and to pay for the gallon. You've had an economic consequence. The taxing government has an economic benefit, which is the tax payment. Now that's just 1 gallon. That's insignificant. But let's say the gas station sells hundreds of gallons each day, and that station is one of many in your jurisdiction. Those individual transactions may not be material, but in the aggregate, they sure do add up. Finally, there are substantive rights and obligations. You receive the gallons of gas in exchange for your payments. But let's say you wanted some other stuff at the gas station. You got some Powerball tickets, you got some snacks, you got some windshield washer fluid. The gas station allows all those on one credit card swipe. There are multiple transactions in those purchases involving multiple taxes and multiple governments, especially if you buy the Powerball tickets, but all have the same terms and conditions. You have a right to have what you purchased, but you need to pay for them. Now let's put this in a little bit of English and let's try to figure out short term versus long term. So Eide Bailey provides your government an engagement letter. The engagement letter indicates that Eide Bailey is going to audit your government in accordance with the contract in exchange for payment. Now that's a binding arrangement if both sides fulfill the terms and conditions in the contract. A payable would be declared at each milestone or at inception if there are no milestones in the contract. Some of our contracts contain separate billing for interim field work, single audit, and so on to spread out the budget. And this is no different. There would be 3 phases effectively, but the timeline from the left side of the screen to the right side of the screen is how you measure a transaction. Now let's keep going on this one. Again, your government engages us, and that's when the transaction starts. Government settles payment with us, and that's where either the payable, we've already declared a payable or receivable, but depending on the timing of it is when things would be due. And that's how we're going to measure that transaction. And the time frame, if it's 1 year or less, that's going to be short term. If it's more than 1 year, that's going to be long term, and it doesn't matter when your year end is. That's the proposal. Okay, so that gets us to our next polling question. And maybe we just leave this up here on the screen. And given the fact there's a little bit of a fact pattern here, and it goes to the short term versus long term here. Let's figure this out. What do you think? Some people say short term, some people say long term. Well, I could make a case for short term if there are milestones in the contract. It depends on the language within the contract. But if we don't have milestones in the contract, if we don't have separate deliverables in the contract, one would think this could be long term. So that's how we're going to, and actually the answer as proposed by GASB is long term on this one, because notice your dates. We sign an engagement letter on January 29th, 2025, and we're talking June 30, 2025 is our year end. but gee, the single audit is not due until March 31st of the following year, which the city always files. And payments are due from the city to Eide Bailey within 30 days of each deliverable. It depends on the language that's here. If indeed the financial statements are a separate deliverable, I could say that that's a short term, on it. But if there's no deliverables other than the entirety of the financial statements, that could be long term because it's inception of the transaction to when final payment is expected. And that's going to be a hard thing to consider as a change. Okay, so let's keep going. Where does this all lead us? The inflows, taxation, charges, licenses, fees, fines, investment earnings, transfers, and so on. Not many changes, in terms of what would be in your financial statements for your assets and liabilities. Even the long-term debt issued for short-term purposes, that is currently in GAAP as a potential liability as long as it's beyond 1 year. And we do that with TANs and RANs and so on, if your government even is allowed to issue TANs and RANs. But this is what it looks like, not too tough to take. Let's go through some transactions and compare the transactions in the exposure draft to what is in current GAAP. Let's take a look at inventory. Gee, not too much of a change here. And again, you can go through these at your leisure. By all means, take a look. Special assessments, those are usually things like curb cuts or infrastructure for a new subdivision. You got a little bit of a change there. Let's go to the next one, claims payable. Currently, we don't really do a liability. We only really recognize cash flow going out, the expenditures. But guess what? A large short-term payable may be declared based on the facts and circumstances within the claim. Bonds payable, that'll be a non-current activity, a long-term activity. And that's pretty much as what we do today. We don't put bonds payable within our governmental fund statements unless they've matured, but we haven't paid our outstanding balances. But again, don't take these to the bank. Again, this is just an exposure draft. And again, your circumstances may differ. After all, your government may have a 60-day accrual period for property taxes, as many of us do, and this may change things. But other governments may have a 1-year period on property taxes, and there might not be a change. But take a look at the differences that could be there on taxes receivable, revenue transactions. These could be very different in your government. So many transactions may change on this one. Be careful. Analyze what is in the appendix to the GASB's exposure draft and try to apply it to what is in your facts and circumstances. But good news, no pensions, no OPEB liabilities unless they are due but unpaid. So hopefully your anxiety level has gone down a little bit in terms of your governmental funds. And again, yeah, I'm reemphasizing some of this stuff in terms of taxes receivable, income taxes receivable. Yeah, could be some minor change, but it depends on your facts and circumstances. Again, 60-day accrual period, that could change. That could change. It really depends on how you set up your taxation system. Hopefully, again, your anxiety level has gone down. Again, it could have been worse. So let's go to the next step. What about long-term and non-current activities? Well, you've seen this somewhere before. Debt service and issuance, capital outlay, sale of capital assets, transfers. Wait a second. Those are what you're doing today in other financing sources and uses. Yep. All we're doing is changing the terminology and then summarizing them. Not too tough to take. And again, I'm trying to lower your anxiety level over this one. Not too tough to take at all. Now, since the measurement focus and basis of accounting is changing, the names of the statements are proposed to change. That is a little bit of a challenge for some of us. Some of the elements are proposed to change, but again, this could have been so much worse. The preliminary views contained an introductory statement that looked like a disclaimer of opinion at the top of every single financial statement in the governmental funds. I don't know of any response letter to the GASB that enjoyed having a disclaimer at the top of the page of every single governmental fund financial statement. It's sort of like in The Wizard of Oz, where the wizard said, "Don't look at the man behind the behind the curtain as he was running the wheels and so on." So it was the same way. And the audit community, they really didn't appreciate that. So now, if you take a look at what's on the lower third of the slide there, you'll notice a change that we'll get back to in a few seconds in the resource flow statement. And just wait for it. You'll notice a little bit of a change there. What happens to the reconciling pages? Well, due to the change in the measurement focus and basis of accounting, the reconciliations may actually be shorter than what you currently present. And in fact, you may even be able to get them on the same page as the short-term financial resources balance sheet and the flow statement. And I'll show you one of these in a bit. Now let's take a look at that balance sheet that I just mentioned. Not too many changes except for the special resources fund and the reconciliation. Of course, the devil's in the detail of the underlying transactions. But as a reminder, the underlying information was actually taken from a real city. Not too tough to take here. Now let's take a look about the reconciliation. There are probably fewer lines than what you're doing today, but again, pretty straightforward stuff. It could go on the bottom of the page. It may just fit there for some governments, but for this presentation, I really needed to put it on a separate slide because that font was pretty small. Now, what is in there? Again, you can probably easily see and point to your current annual financial report, and you could say, gee, it looks like what we're doing today: capital outlay, long-term notes and other receivables, internal service funds, assets and liabilities, long-term liabilities, bonds and other items, pensions, OPEB. Looks familiar. But there's just a handful of items that are missing. Again, not too tough to take. Now let's go to the P&L. As I learned it in school, we called these P&Ls. The statement of short-term financial resource flows includes inflows of resources from current activities, and we're going to detail those and total them. Outflows of resources from current activities, and we're going to detail them, and then we're going to total them. And then we're going to have net flows from current activities. And then we're going to have net flows from non-current activities. That's the slide I showed you a couple of slides back. And we're going to total that. And then we have those unusual or infrequent items. And again, we're going to detail those if there's more than one category of them. And then we're going to flux our fund balances. Now, I could show you the statement, the reconciliation statement, but it is tiny and it's available from the GASB. The print on it was just so tiny. Now, the change you may have missed. The word expenditure is not on this slide. And the word expenditure is not in the short-term financial resources flows statement title. It's not there. Notice it says outflows. And notice on the revenue side, it says inflows. Guess what? The word revenue is not in the title. Now, again, that is a change due to the change in the measurement focus and basis of accounting. With the GASB is proposing not to use the word expenditure anymore. And the word revenue would be inflows under the guise of a fund statement. Revenue will still be presented in things like your proprietary fund statements and things like your government-wide statements, but not in the governmental fund statements. That leads us to our next polling question. And that pretty much beats the heck out of the measurement focus and basis of accounting. So what do we think here?
So far, you have 24% that say maybe make my job more difficult.
Yeah, yeah. I think it really depends on your government. In some cases, it will make your job a little bit more difficult. In other cases, not too tough to take. And of course, other cases, you don't have governmental funds, and in which case, who cares? And so this is something to really sit down and consider, especially if you're going to respond to this, as to how you think this will impact your government. So that's the governmental funds, but of course, there's more. The GASB is also proposing changes for proprietary funds. And I know those of you who don't have governmental funds, you're going to perk up right now. Well, right now, GAAP allows governments to determine what is in non operating, and then you disclose it in your notes and then align to it as a significant accounting policy. And of course, as auditors, we have to test whether or not you're aligning to it. And that's always a fun conversation when you're not. Gee, you call this non-operating, and yet you think it's operating. And so GASB is going to take a bunch of the guesswork out of it in the exposure draft, assuming it's approved as drafted. In the exposure draft, non-operating is proposed to be subsidies received and provided, revenues and expenses related to financing, resources from the disposal of capital assets and inventory, and investment income and expenses. That's non operating. Okay. Then, if you have stuff beyond that stuff, then that would be operating. Most revenues and expenses then will be operating revenues and expenses. For entities that are financing entities, interest revenues and expenses, that would move to operating, and that is already in GAAP. That's been around since GASB 9 back in the mid 1990s or early 1990s. That's the same as what we do today in the statement of cash flows. So all we're doing is we're codifying that, and we're finally identifying this word subsidy. The word subsidy has never been defined in GAAP prior to the exposure draft. The GASB is proposing that subsidies would be as it is on your screen here. I'm not going to read it. But for those of you who have transit systems, airports, education, healthcare, and so on, especially during this time of COVID, you're going to have huge fluxes between what is operating and what is non-operating using this definition. And I was on the subcommittee that drafted this language, and getting this wording right took months. But ultimately, it came from a university CFO and a few others along with me working on this. And if you're one of these entities, review this, because the impact may make sense. But in another case I talked to, they have a little bit of a challenge, in terms of this wording. So think about it as you're going through it and potentially responding. So, how does this all look in your statement of revenues and changes in fund net position? Again, not too tough to take. We have a new section on non-capital subsidies, which would include transfers in and transfers out. And for those of you again who love your statement of cash flows as much as I do, yeah, right. No changes in what is being proposed. And for those of you who loathe the direct method, I tried for about a year to, hey, GASB, let's just go back to the indirect method. Unfortunately, the board did not agree. No changes coming to this statement of cash flows. Now, let's take a look and see what this would do to a real financial statement. And in this case, the Golden Gate Bridge Highway and Transit District, which, if you're on the line, I really thank you for allowing me to use your financial statements today. And I'm going to give you a little bit of a leg up, even though this is not going to be implemented perhaps for a few years. I'm going to give you a little bit of leg up, and I want to thank you for this. There would be no change for the iconic bridge in terms of operating versus non-operating, but the captions in the non-operating section might change. And I use the word might as we're not at a final standard as of yet. But otherwise, the change is probably not too tough to take. The tolls, transit fares, operations, maintenance, depreciation, administration, they're all going to probably remain operating. There's going to be some changes in captions, but that's about it. So if you happen to be the CFO of the Golden Gate Bridge or the controller, reach out to us, and I'm more than happy to walk you through this if the print's pretty tiny. That leads us to our next polling question. What do you think about the subsidies?
So far, option B and C are tied.
They're tied. Not a large change. Yeah, I think it really is going to depend on your entity as to how much of a change. I mean, some of you may be just like the Golden Gate Bridge, who we love, actually one of our clients. Probably not too tough of a change, but others, it may be some serious change that is going on. It really will depend. So let's keep going. There are some other stuff in the exposure draft. Governments have had the ability to present component unit information in condensed form in the notes. In the exposure draft, there's a proposal to present component units as separate columns in the statement of net position and the statement of activities as long as it is readable. Now, if it's not readable, combining statements are allowed. Our largest governments have over 50 component units, and combining would be the best way to go here anyway. So again, not too tough to take, not a big change. The budget comparison information is proposed to move to RSI. Now, we're still going to present the general fund and each major special resources fund that has a legally adopted budget. But again, not too tough to take. The budget comparison information is going to have original and final budget amounts and final budget amounts versus actual amounts. That's going to be your variance column. But you're probably saying, Eric, what happened to the MD&A information? Well, just like the pension and OPEB notes to RSI, that's where your budgetary comparison information is going to go. Again, we're going to have significant variations between original and final budget amounts and final budget and actual amounts that will be analyzed within the notes. The analysis should include any currently known reasons for the variations that are expected to have a significant impact on the budgetary fund balance or to produce significant differences from the current period budgetary results. This is the same exact language in the MD&A section of GASB 34, and it's been used for 20 some odd years, and now it's just going to move to the RSI. But remember, the MD&A technically already is RSI, so not much changing other than where it is in your financial statements. Let's take a look at the component unit presentation. Again, not much different here. I had to, zoom in terms of the printing, or else it would have looked really, really small. I could have copied the entire thing, but you can see it in the exposure draft if you're really interested. They use combining schedules, so not too tough to take. Here's where this is a little bit smaller, and again, you can see it in the exposure draft, and you can see the variance columns in the center of the screen, and there's a variance column with the final budget in the right hand side of the screen. Again, pretty much the same way as we do today, except slightly different variances. Now, the current non-current format is not a requirement on here, but some governments might want to put that in there, similarly to the way that your fund financial statements would be, and that would make the reconciliation a little bit easier for you to do. Now, if you don't want to put it in, it's okay. It's really up to how you do your budget. And this is the reconciliation information that would be for your special resources fund. And again, it all depends on how you do your budget. Given the nature of the fund, in this case, the flows are very highly summarized. But what does the note to the financial statements, note to the RSI, look like? In this case, it's a simple reconciliation page. The item can be in the form of a table or it can be in paragraph form. The elements to the reconciling items, though, would differ from government to government, so you're gonna need to be careful on how this is presented. Now, I know there may be some governments out there that are required to have budgetary information as a basic financial statement. GASB knows this, and I'm sure you may comment on the fact that there may be a situation where you have a state law that requires budgetary information as a basic financial statements. Make sure if you do comment, make sure you mention that. And it's up to the GASB as to whether or not they're going to change it or not, or maybe have an exception for you. So keep that in mind as you go through this. The exposure draft clarifies financial trends in the statistical section of the annual report. I did not include that in here because, you know, something, it's very easy to understand. Governments engaged only in business type activities or only in business type and fiduciary activities would present revenues by major source for their BTA, distinguishing between operating, non-capital subsidy, and other non-operating revenues and expenses. It's pretty much what's being proposed in the exposure draft. You just change your statistical section if you prepare an annual financial comprehensive report. Notice I just changed the name. Annual comprehensive financial report. It's not a comprehensive annual financial report. Don't change your acronym as of yet, but stay tuned. You'll hear more about it later this year. The GASB is about to propose to change the name of the comprehensive annual financial report. Stay tuned, breaking news. You'll see an exposure draft probably coming out by the end of February on this one. Why? Because in some cultures, the abbreviation for comprehensive annual financial report is a derogatory term. And if you look on GFOA's website, for example, GFOA has already started the change. And so stay tuned. It's about to come out. And again, not final as of yet, but I haven't used that abbreviation all afternoon. Now that you know this is not a huge amount of changes, but significant enough. So what is the GASB proposing for transition? Back when we had GASB 34, if you remember, we had three phases. We had phase one, financial statements for periods beginning after June 15 of 2001. Gosh, that was a long time ago. Phase two, financial statements for periods beginning after June 15 of 02. And then phase three for periods beginning a year later after 2003. And we measured the phases, the breakpoints of the amount of money that was measured for the first fiscal year ending after June 15 of 1999. And the breakpoints were 100 million for phase one, 10 million for phase two, and below 10 million for phase three. And we had a grace period for infrastructure. Well, now the proposal is measuring your total annual revenues for the first fiscal year beginning after June of 22, meaning July 1st of 22 to June 30 of 23. And if your government is above 75 million, the implementation would be for a June 30 government above 75 million as of that previous year measurement date, July 1st of 24 to June 30 of 25. Less than 75 million, you got a year grace period. But if you're a component unit of a government that's 75 million or more, you got to follow the primary government. Not too tough to take. And for those planning retirement, that might give you a sense of the timeline. How do you calculate? Well, it's the total inflows or additions except for extraordinary and special items. That's the exact same calculation we did when we implemented GASB 34 20 years ago. It's the exact same calculation. Interestingly enough, it is a retroactive application for all prior periods presented. Now, at the last minute, I brought up said to the board, okay, well, what about the MD&A? If a government presents comparable financial statements, wouldn't it be a restatement going back 2 years since they're comparable? And the board looked at each other and they said, oh, yeah, that's an issue. The last minute change allows governments to not restate prior periods for purposes of providing comparative data for the MD&A. However, governments are encouraged to provide some form of comparative analysis of key elements of governmental activities and business type activities, the way it's reported in your government-wide financial statements in the MD&A for the period, thinking that the government-wide financial statement is probably not going to change all that much. Now, how did the GASB figure out 75 million as a breakpoint? It was 100 million in 1999. How did they figure out 75 million? I mean, the economy expanded over the last 20 years. Well, GASB staff did a major undertaking looking at the entire 2012 census of governments. The 2017 data was not fully available, so they went back to 2012. And then they apportioned the governments by revenue ranges and by census type. Of course, the 50 states were above 250 million. That was easy. But then the government started to fall into the different categories. Notice the percentages in the right column. Just a little over 6% of the count of governments, the top 5,388 have revenues above 50 million. The remaining 84,923 have revenues below 50 million. So guess what? The GASB split the difference. They said 75 million. They said they said, okay, calculate 75 million. And GASB staff figured that between 3.02% and 5.96% of the governments will implement the first year. The rest of you will learn from the first year governments, just like we did back in GASB 34. And again, remember, all component units within a reporting entity would implement the same time as a reporting entity, as the primary government. So again, think about that as you're commenting. Not too tough to take on this. The responses are due February 26th. That's a little less than 1 month. You have a little bit of time to go through this. Now, again, there is that concept statement. We're not talking about it today, but it mirrors the short-term financial resources measurement focus of the exposure draft. There's also the revenue and expense recognition PV, which to some may be more of a challenge to comment on because it's a lot more theoretical. Comments are due on all three around the same time in February. Now, the preliminary views document from a few years ago contained multiple alternative views. This one just contains one dissension. A board member dissented for three primary reasons. The first being that the statement continues the movement of governmental fund accounting away from the budget. And this board member really didn't like that. And the board member also thought there was a conceptual flaw because it didn't facilitate, in their mind, any significant operational decisions or evaluative judgments. It also failed to address the most significant limitations of the current financial accounting and financial reporting model. And the board member felt that the exposure draft didn't go far enough. The board member felt that the importance of linking the budget to governmental funds, it's been in place since well before the GASB, and likely since modern governmental accounting began over 100 years ago. Budgets have been presented since then as an important set of internal controls. And the board member believed that the short-term financial resources measurement focus is such a compromise that the core objectives of governmental funds are not met. budgetary compliance, and aligning the current revenues to current flows for services. The second piece is the board member believed that the liabilities may be understated and I mentioned, in passing, a a debt that matured at 12:01 a.m. the following day after the reporting period. And the board member felt that should be a liability. To illustrate what the board member presented, let's take a look at a piece of debt and debt issuance and maturity. And notice that the different perspectives between the two governments based on when the reporting date would be of the balance sheet and the provisions in the exposure draft. Now, simply due to the issuance date and maturity date in Government A, there would be a $10 million liability due to the 1 year maturity because that's the period of the transaction. But had the maturity been 5 years, no liability, as in Government B. So quite a stark change, based on that maturity row there. Very much of a stark change. Now, knowing this as an alternative, the board member did propose reporting governmental funds on a budgetary basis and then layering on accruals to get to the modified accrual basis and then reporting after some changes to the government wide. For some of you, this may be the exact process of what you do today. Now, I've only summarized this board member's views. If you do believe that you want to align to the alternative view, which I have no opinion on personally, I encourage you to read it in detail and make a decision because, hey, it may align to the way that you want to see things done. So, with that, I know time's getting a little short here. Let's take a look at the calendar. I gave you the timeline for the financial reporting model project. What about the other big projects that are going on? The note disclosure conceptual framework looks like we're going to get a concept statement on notes, not a redo of the notes, but a concept statement on our note disclosure. That's going to be coming out in May. That's looking pretty good right now. Not too much dissension as of yet. And then we talked about the financial reporting model. Looks like the final is going to come out in May of 2022, assuming it passes as it is proposed. Again, not too tough to take. I mentioned in passing the revenue and expense project. We're going to be speaking over 3 hours on this, over 3 webinars, February, March, and April. It is really detailed, so it's going to take a little bit to go through. And I know we'll miss the comment period, but something, I'll give you a dirty little secret. GASB accepts comment letters even if it's after the due date. So if you do have a comment on that one, it's okay. Send it in. I mentioned again this project. That project might update GASB 33 and a number of other standards. But if you take a look at the over right-hand side, we're not looking at a final standard until 2025 on that one. So I hope you can sleep at night on this one. Let's take a look at the rest of the calendar for this year to wrap up our period together, or as I used to call it when I was a CFO of a state authority over 20 years ago, this is what I called the visible supply. So let's take a look at the visible supply of what's coming up over the next couple of years. Most of us took advantage of GASB 95 and are now implementing GASB 84. And a few of us might have GASB 90 issues that we're dealing with. And then coming up right after that is GASB 89. Not too tough to take this year. Some of us have already started down the road and in implementing GASB 87, GASB 92, which is already effective for some parts, and for some of us, GASB 91 could be a very big impact. I just wrote an article on GASB 91 for CCH. It does have some impact, and as you implement leases, and if they're financed by conduit debt obligations, you may want to take a look at GASB 91 out there because it's a little bit of a sleeper. I also note GASB 93 has an impact in 2022, but there have been articles over the past couple of weeks that the regulatory body in the United Kingdom that regulates LIBOR may be revisiting the sunset date of LIBOR because of COVID-19. There was an article about a week and a half ago in the Wall Street Journal on that. They may extend it either 3, 6, or 12 months. Could land up actually even going to June of 2023. And if they do extend, it's unclear as to what happens with GASB 93. We also have GASB 97 coming up but for some parts, again, were implemented immediately, and some governments may implement GASB 97 at the exact same time as GASB 84. And then coming up a little bit later, we have GASB 94 and 96. Again, we got a couple of years to think about it. Okay, but what about as some in government call it, the known unknowns? Breaking news coming out in a few weeks. There's an exposure draft potentially re-examining GAAP for compensated absences. Again, February 21 could be released. This might be a 2023-2024 implementation, but also look in the middle of the screen. And I mentioned this a few minutes ago. You're going to be hearing this first. We need to get used to not using the abbreviation we all know, assuming this goes through. Imagine a world where that abbreviation is a derogatory term. And it is to some cultures. The change being proposed in this exposure draft should be coming out over the next few weeks. And the GASB would propose to change things starting with the December 31st, 2021 financial reporting season. Stay tuned for further updates on this one. Again, coming out perhaps within a month as the exposure draft is in process. We may send out a bulletin email to clients and post something on our website that this is being proposed once we get the final language. And that brings us to our final polling question, Amy.
All right, guys, go ahead and answer that last polling question. Eric, since we are short on time, let's just go ahead and leave it open for them to answer. You continue on and we'll talk about the results a little later.
This is our upcoming schedule. I mentioned a few times that during February, March, and April, we're going to be spending an hour each on the revenue and expense recognition project. Again, these are all free, just like today. Mark your calendars coming up. May 26th, we're going to go back down the rabbit hole of GASB 84 and 97. For those of you who are June 30 governments who have not implemented, that's your last and best chance to hear about GASB 84 and 97 for a scintillating hour and a half. And then we're going to close 6 months, this 6-month period of webinars on June 23rd. And there's going to be some other GAAP we're going to consider this year, and some of which I just really mentioned quickly. Hopefully by then, we'll know additional details about what might happen about renaming the annual financial report. So with that, any other questions?
Perfect. We can show this last result here.
Yeah. See, I think that the top one, that's really going to be important. I think once you see the final language coming out, and we'll know some of the final language coming out if you happen to be a GASB geek, you can follow along on their website because they list all the tentative conclusions within each project. You can follow along and you can say, hey, wait a second, I need to take a look at my policies and procedures and how I do my financial reporting pretty quick, because guess what? 2024 is going to be right around the corner. It's 2021 right now. So it might not be a bad idea. So with that, any questions, Amy, in the chat room?
There are a few. So let's see, this was from probably, just a few slides ago. It says, any discussion about how the additional funds being received relating to COVID will affect the calculation for the total annual revenues?
Well, good question, since they wouldn't be an extraordinary or special item, and that's going to be excluded from the calculation as proposed, since that would be excluded, you would exclude those. Wait a second, I said that wrong. COVID monies are not extraordinary special items. They're either they're probably program revenues, and as such, they would be calculated as part of that. And could you go above the 75 million? Maybe, but that would be up to whenever the measurement period would be. The measurement period right now would be the fiscal year in 2022. So one would hope that the bulk of the COVID money would be depleted by then. Let's all hope COVID's behind us pretty quick. I'm hoping. But that's an excellent question. Since they're not extraordinary special items, they would be part of your program revenues.
All right, so then the next one says, it's pretty generic, for less 75 million, 930, when does this start?
When would it start? Well, in the exposure draft, they put in a measurement period for, let's go back there. Let's see if we can go back here. Let's read it one more time. The period would begin, hang on, let's go back. There we go. The measurement period would be the first fiscal year beginning after June 15 of 2022. So if you're September 30th, you would start October 1st of 2022 and go to September 30th of 2023. That would be your period, assuming these dates do not change. Good question.
All right, and the last question here says, for the reconciliations, can you put the balance sheet on a separate page but add the resource flows on the same page, or do they have to be consistent?
Oh, good question. It might not be practical to put your balance sheet and your resource flows in the same page, depending on your government's operations. Your print might be very small, and might not be all that readable, especially if you have to put balance sheet reconciliation, resource flows reconciliation all on the same page. I would attempt to do balance sheet reconciliation on one page, or on one page and then a following page, and then resource flows and reconciliation on separate pages after that. The GASB did not get into that level of detail in the exposure draft, but my guess is if you happen to be part of the Certificate of Achievement program at the GFOA, and you file on that every year for the award, they're probably going to put something in saying that the print has to be readable, and the current provisions have facing pages. And again, that's not GASB GAAP. That's just a checklist item in GFOA.
All right.
Anything else?
That's all the questions.
Stuck the landing again, Amy. This is great, right near the top of the hour. Well, with that, I look forward to hearing from you. My email is in the PDF. Certainly, you know how to reach out to me. We thank you for spending your day with us, and we hope to see you coming back in February.